Hello and welcome to the week ahead from the Financial Times in London. Here are some of the stories we'll be watching in the coming days. Disney opens its first theme park in mainland China. The owner of the Zara fashion chain issues first quarter results. And monetary policy dominates the economic agenda as central bankers from the US, Japan, England and Switzerland decide on interest rates. First to China, where the world's largest entertainment company is trying to win over the hearts of the country's children, as well as their parents' wallets. The first Disneyland resort in mainland China is set to open in Shanghai on June the 16th. The $8 billion joint venture with three government-owned companies pits Disney against Wonder City, Dalian Wonder Group's recently opened leisure resort. Both companies are betting on the new thirst in China for leisure activities, and Disney's banking on its international movie hits attracting younger visitors. Its new park features attractions based on Pirates of the Caribbean and superhero pictures such as Iron Man and Avengers Assemble. And Disney reckons its globally recognised characters will draw visitors from across China, where per capita income has grown 20-fold in a generation. But will Disney's gamble pay off? Here's the verdict from our correspondent Charles Clover, who visited the new resort in Shanghai.
These gates will open officially and we'll all find out how popular Shanghai Disney really is. This moment has been a long time in coming for Disney. They say they've been waiting 17 years, and with their local partners they've spent $8 billion on this attraction. That's a lot of money, and to recoup that cost, they're charging twice what their nearest local competitor is charging, $76 for a Saturday at this park. Now, that's not cheap in a city where the average monthly income is about $1,400. But I wouldn't bet against it, because if there's one thing that Chinese like to spend money on, it's their kids. And if there's anything that Chinese kids like, it's Captain Jack Sparrow and it's Princess Elsa from the movie Frozen.
Now to the retail world. When will the Inditex growth story finally run out of steam? Well, not in this quarter, say analysts, who predict the largest fashion retailer in the world by sales will turn in yet another set of strong results this week. Since it floated on the Madrid stock market in 2001, the group has quickly risen up the ranking of global fashion stores, and so far isn't showing any signs of a setback. Inditex owns the Zara fashion chain and has benefited from years of investment in both online shopping and its physical stores. The consensus forecast suggests Inditex will unveil pre-tax profits of €708 million. Our Madrid bureau chief Tobias Buck has more.
Markets are expecting a fairly strong rise in sales, including like-for-like sales. One thing that will be interesting about the first quarter results, I think, is that you won't see this strong rise in like-for-like sales translated into a similar rise in earnings. And that is because Inditex still has a lot of production and much of its cost base in Spain and in other Eurozone countries. And that means that when the euro rises against other key currencies, as is happening now, profits at Inditex do take a hit.
And finally, to monetary policy, which is set to dominate this week's economic agenda. Central bankers from the Federal Reserve, as well as those from the banks of Japan, England and Switzerland, are all due to meet for their June decisions on interest rates. The Fed was previously expected to raise rates, but employment data from May showing just 38,000 jobs were added against an expected 160,000, all but killed the chances of this. Fed Chair Janet Yellen confirmed this sentiment recently when she described current policy as generally appropriate. Here's what our economics correspondent Gemma Tetlow had to say.
It seems likely that the meetings of the central banks this week will see them all holding fire on any further policy announcements. For the Swiss National Bank, for the Fed and for the Bank of England, Brexit is probably going to be playing on their minds, and they will all probably hold fire to see how that plays out before making further moves later in the summer. For the Bank of Japan, there are elections coming up there in early July, which again will probably lead them to hold fire. Having said that, the Bank of Japan do like to surprise people, so we should never rule out the unexpected there.
We'll also be watching UK inflation data on Tuesday. A slight uptick is expected in May due to further increases in fuel prices. But with CPI still so far from the target, it's unlikely the data will affect the Bank of England's rate decision on Thursday, when they're expected to keep policy unchanged. And that's what the week ahead looks like from the Financial Times in London. See you again next time.